Hi guys, we are Josara and welcome to our 20 Stock Weekly Challenge. We are at week 3. Okay, for those of you who would like to stay connected with us, you can add us on Facebook, or you can check out our YouTube channel, or you can go into our free course, JS free course. So in this free course, we actually have a lot more stock analysis and some of our MMG materials. Yeah, so feel free to have a look at it.
Okay, just to a quick add-on. Okay, something big is going to happen to our free course in the next week or two. So really, do keep a lookout.
Yes, once in a lifetime chance. Okay, so we are husband and wife team, and Joe is.
I'm actually Mr. Fundamental Analysis.
And I am Miss Technical Analysis. So together we are.
Fata, which means to be extremely prosperous in Chinese.
So we believe that when you combine fundamental analysis and technical analysis together, we are better. And we hope that through our analysis, we can help everyone to be extremely prosperous as well through value investing. Okay, so for those of us who are new to this 20 Stock Weekly Challenge, it is actually a challenge that Joe and I put on ourselves to identify 20 stocks that will allow all of us to profit regardless of market direction. So this is really earning passive income for a lifetime. And for week 3,
okay, we are going to introduce a stock which gives a 4.8% dividend yield without tax.
Yes. Okay, so for those of you who have been following us on Facebook, you would know that in November, okay, I posted this video, and yes, all of you guessed right, I was in China. So, what is this stock that is going to give us a 4.8% dividend yield? Drum roll, please. Okay, it is.
It is none other than ICBC, or the Industrial and Commercial Bank of China.
Yes, and it's going to give you a recurring 4.8% dividend yield without doing anything.
Alright, so as of now, the share price is around 5.79, 5.8 Hong Kong dollars. This translates to Singapore dollars of slightly more than $1. So imagine this, you even pay more for a cup of coffee at the Void Deck, and your coffee doesn't give you a 4.8% return every year.
Yes, this is really like 4.8% cashback, okay, for every dollar that you invest in ICBC. Okay, so how do we calculate dividend yield? It is dividend divided by share price. So ICBC is giving a dividend of 0.28. If we divide that by the share price, that gives us a 4.8% cashback or dividend yield with no withholding tax. Yay!
Is it better than some credit cards? I think so.
Yes, definitely.
Alright, so from now on, I'm going to use fundamental analysis to show you why ICBC is such a strong bank. Okay, a quick check on Google. If you type in the largest bank in the world, it will give you this result. Okay, and it shows ICBC is actually the top bank in the world in terms of assets. All right, so its financial muscle is huge. They have plenty of assets, and if you do a quick checkout on Morningstar, you will see that the earnings per share is actually increasing quite steadily. Free cash flow over the past few years, it has been increasing tremendously. Alright, so yes, from what Google state, the figures back it up. Okay, some more Morningstar info. Net margin, it has been hovering around the low 40s to the high 30s, so I would say it's pretty strong. Return on assets, it seemed a little bit low, but do remember that ICBC has so much assets. This 1.06, 1.1% is going to give huge
Hey
revenue.
Joe, what is the normal benchmark for return on assets? Why do you say that 1.06 is low?
I don't know what's the correct benchmark. I don't know if there's such a thing. Okay, but if I would say, if based on the assets they can only generate a 1 point something percent, to me it will seem low, because if I put my assets, my money into a bank, it gives me a 1.06%, I wouldn't be too happy. Alright, but do note that ICBC has so much assets. The 1.06% can translate to a huge amount.
I see.
Alright, for the return on equity, alright, it is not too fantastic, okay, but not too shabby also. Quite consistent, around 12 to 14%. So I would still say it is pretty okay. If you see that throughout the years it has been decreasing, Warren Buffett actually has a explanation for it. He explains that, okay, banks with low ROE or return of equity can actually mean that they are trying to take on safer loans, okay, or they are trying to give out not so risky loans to the masses.
Oh, I see.
So that's why their return on equity is going lower. All right. So do the numbers back it up? Actually, if you check the debt to equity ratio, this can be found in Morningstar also. You will find that actually ICBC's debt to equity ratio is 0.28, which is fantastic. Any company with a DE ratio of less than 0.5 is considered very good, which means that they have 2 times more equity to their debt. All right. And for ICBC, it's more than 2 times. What's more fantastic is that because it's a bank, the nature of a bank business is that they have to borrow money and then they have to loan it out. So all these things will actually cause them to take on a lot of debt. All right. So for ICBC to maintain it under 0.5, wow, it's phenomenal even. Okay. So if we look at the portfolio of ICBC, their business is in actually their portfolio is in a lot of industries. All right, transportation, manufacturing, all the way to real estate, construction and mining. So I would say this is pretty safe. Okay, they are not overly exposed to only one industry. So when things do not go so well, they should be quite protected. All right. So the other metric that we are very concerned about for a bank is actually the net interest margin. This gives us the interest that they are earning, overall interest that they are earning when they borrow money and they lend money. So as we know, a bank usually gives you when you put money with the bank, the interest rate is like 1%. But if you borrow money from a bank, they will charge you 3 or even 4% interest. So this is their net interest margin. For ICBC, it is not too high. It is 2.3%. Okay, it may seem low, but do remember of the amount of assets they have. This 2.3% can actually translate to quite a lot. All right. And okay, because of the 2008-2009 bank crash, which happened to Lehman Brothers, Goldman Sachs, all these things. So one very important thing to look at for a bank is actually the non-performing loans. This is actually the loans that the banks term that is bad, which they feel that they don't have much chance of getting the money back. So what they do is actually they have to calculate the percentage. And for banks, usually we don't want to invest in a bank with an NPL ratio of higher than 2%. So for ICBC, as of now, it is pretty safe, 1.52. All right, and what happens is they actually allocate 175 million Chinese yuan, okay, to cater for these non-performing loans, and the ratio of the allowance that they set aside compared to the loans is actually 2.68. That means they have set aside more than twice the amount of allowance needed to cover this. This shows how much money they have and they can spare. All right. A more in-depth check, the NPL ratio for in Q3 2019 has actually gone down to 1.44%. All right. So they are actually trying to reduce their NPL ratio, which is good news for any investor who has invested in ICBC. All right. To check that the numbers do back it up, their cash and cash equivalents at the end of 2018 was actually 1.5 over 1.5 billion. So yes, they are strong and they can really safely and very comfortably spare that spare cash, okay, to actually cover these non-performing loans. So they are really quite safe in my opinion. But if you ask me, is ICBC a totally perfect bank? I wouldn't say so. Why? Because when I look through their annual report, they are only exposed to mostly in their own country. They don't have a lot of business overseas, and this could be a problem area when, let's say, China goes into recession or something like that. All right, so this is one thing you may need to know, or you may want to know before you invest in ICBC. Okay.
Okay, so next let's take a look at the technical analysis to determine entry and exit. Okay, so is this a good time to enter ICBC? If we take a look at the charts, we would realize that over the past year, this is a 1-year chart. Okay, over a past year, the share price has usually reached a support level of 5.41. Okay, after every 3 to 4 months. Yeah, so if let's say you really want to wait, you can wait for it to drop further to 5.41. Okay, but actually, to be very, very honest, even at 5.63, which is the current price, you already get a 4.8% dividend yield, which is already very good. So, I mean, for ourselves, personally, we are going to get it at the current price really, because even if we wait till 5.41, it's not going to make much of a difference to the dividend yield anyway. And we are getting this stock mainly for the dividend yield. Okay, however, for those of our friends who are getting this stock for capital gains purposes, that means you wish to actually sell off this stock when it has appreciated to its capital gain, then you can consider getting the stock at 5.41, and then you can exit at around $6. Okay, but for Joe and I, we really want to keep this stock for a very long time, okay, because of its dividend yield, and there's no withholding tax, and we just get around 5% dividend yield every year without doing anything. And furthermore, if we look at the book value per share, this refers to the net assets of the bank. So this means that if one day the bank were to close down, it would actually have to redistribute 8.32 to the shareholders for every share that they hold. Okay, so this is actually $3 above what we bought ICBC for. So really, it is almost like a risk-free investment. Okay, because we get to hold the stock and get a 5% dividend yield. And what's more, if the bank is ever going to close down, we still earn $3 more per stock. Yes. Okay, so yeah, we hope that you really enjoyed this first stock from China that gives us around 5% dividend yield, and even if the bank were to close down, you still can get $3 more. Wow.
Close down now.
Yeah, close down now. Okay.
Which is very unlikely to happen.
Okay, so we really hope that you enjoyed our Big 3 stock analysis, and do let us know what you think about this bank. Will you invest?
Yes.
Okay, so see you next time. Bye.